So let's talk about one of the most powerful diagnostic tools any business has at its disposal, sales variance analysis. This is how you stop just looking at numbers on a report and start understanding the real story of why things happened the way they did.
We've all been there, right? You get the latest sales report, you're looking at the top line numbers, and something just feels off. Maybe you even beat your sales goal, which should be great news, but then you see your profits are actually down. It's a classic business mystery, and honestly, it can be super frustrating.
Okay, take a look at this exact scenario. This company budgeted to sell 10,000 units and was hoping to make 20 grand in operating income. And the good news? They actually sold 11,000 units. Their total sales were up by $6,000. But, and this is a big but, their operating income dropped by 4,000. More sales, less profit. How in the world does that happen? Well, the answer is kind of hiding in plain sight, right inside the sales variance. Think of this chart as our map. It shows us how we can take that one big, confusing number at the top and break it down piece by piece, layer by layer. Each piece tells a part of the story. So let's follow this map and solve the puzzle. Our investigation starts at the very first fork in the road. See, the total difference between what you planned and what actually happened can pretty much always be split into two main culprits: the price you sold your product for and the number of units, or the volume, you sold. First up, let's look at the sales price variance. To put it simply, this just tells you how much of your profit difference came from selling at a different price than you planned. Did you have to run a big discount to move product, or were you able to charge a premium? This variance isolates that exact effect. And here's how we figure that out. It's a really simple but powerful formula. You just take the difference between your actual selling price and your planned price, and you multiply that by the number of units you actually sold. It's so important because it cleanly separates the impact of your pricing from everything else. So let's apply this to our mystery. The company planned to sell each unit for $17, but they ended up selling them for $16. Just a $1 difference, right? But you multiply that dollar by the 11,000 units they sold, and bam, you've got an $11,000 unfavorable variance. Now, when we say unfavorable, it just means it hurt your profits. A favorable variance, of course, means it helped. This number is our first huge clue. All right, now for the other side of that coin, the sales volume variance. This one measures the impact of simply selling more or fewer units than you planned on. It completely ignores the price for a second and just focuses on the quantity. The formula here is also pretty straightforward. We look at the difference in the number of units sold versus what we budgeted, but then we multiply that by the standard contribution margin per unit. We use contribution margin, not price, because that tells us the actual profit we expected to make on each sale. It gives us a much truer picture of how volume impacted the bottom line. Let's jump back to our example. They sold 1,000 more units than they budgeted for. So we multiply that extra 1,000 units by their planned contribution margin of $7 per unit. And what's the result? A $7,000 favorable volume variance. This shows the clear, positive impact of their efforts to sell more stuff. And here's where it all clicks into place. We had an $11,000 loss from the lower price, but a $7,000 gain from the higher volume. You put those two together, and you get a net loss of $4,000. And just like that, our first mystery is solved. That price discount actually cost them more than the extra sales brought in. But, things are almost never that simple, are they? Most companies sell more than just one thing. And when you have multiple products, each with its own price, its own profitability, a whole new, fascinating layer of analysis opens up. You see that sales volume variance we just calculated? Well, it turns out it's actually hiding two different effects rolled into one. We can split it one level deeper into what's called the sales mix variance and the sales quantity variance. And this, my friends, is where the real detective work begins. So the sales mix variance asks a really interesting question. Did the proportion of products you sold help or hurt you? Think about it. Did you end up selling more of your high-margin premium product and less of your entry-level one, or was it the other way around? In this new multi-product example, the company's plan was to sell 60% plastic units and 40% metal units. But what really happened was a 50-50 split. Since their metal units are less profitable, shifting sales away from the higher margin plastic product created an unfavorable mix variance of $26. Now, the other half of that puzzle is the sales quantity variance. This one is simpler. It ignores the mix completely and just asks, overall, across all your products, did you sell more or fewer total units than you thought you would? Looking at our example again, they plan to sell 500 total units, but actually sold 520. That's 20 extra units out the door. That increase in total volume, when we look at it through the lens of their planned mix, resulted in a $56 favorable variance. They just sold more stuff overall, and that was a good thing. Okay, for those of you who want the deepest possible insight, we can go one last level deeper. We can actually break down that quantity variance to understand not just what our company did, but how we performed against the backdrop of the entire market. This is the final layer of our analysis. That sales quantity number we just found, it's really driven by two big external forces: the size of the whole market and your company's slice of that market pie. The market size variance basically tells you if you are operating with a tailwind or a headwind. Did the entire industry have a fantastic quarter, meaning the whole pie got bigger for everybody? Or was everyone struggling because the market itself shrank? This tells you how much of your performance was just the market carrying you along. And then there's the market share variance. This, to me, is the ultimate competitive scorecard. It measures your performance directly against your rivals. Even if the total market went down, did you manage to grab a bigger piece of what was left? This isolates your company's true competitive strength. All right, we've broken down all the components, we have all the clues. Now it's time to put all the pieces back together and see the complete story of what really happened in our multi-product company. And here it is. The company had a total unfavorable variance of $100. And now we know exactly why. They had an unfavorable price variance of $130, mostly from discounting their metal product. They had an unfavorable mix variance of $26 because they sold a less profitable combination of products. And those two negatives were only partially canceled out by a favorable quantity variance of $56 from selling more units overall. The story is now crystal clear. You see, in the end, variance analysis is so much more than just an accounting exercise. It transforms a single, confusing number into a detailed story about your business, a story about your pricing, your product strategy, and your battles in the marketplace. So the real question is, what story are your numbers waiting to tell you?